Good evening, everyone. Time for this week's silver update. This is the 1 hour chart of silver, and I pulled this up because I wanted to point out a little volume spike that we've had here in the last couple of days. You can see we have put in a nice little volume spike here, which roughly corresponds with this type of bottom, small bottom that we put in here. This volume spike is actually larger than the volume spike that we had at the recent smackdown from roughly 41 down to 26. So this may be a significant point in the chart at some point going ahead in the future. When we pull out to the daily chart, you can see that our MACD on the daily is kind of rolling over, although it's taking a little uptick recently. Here's the volume spike compared to the drop down that we had there. So this trend is still fairly strong. We're still rising off of the 26 bottom. The weekly chart gives us the continued reset on the MACD for the weekly. We're still down in negative territory on one of the lines. The other line is still falling. So we're still looking for a bottom in that. The spike is still very prominent there. We're nowhere close to coming back to that point, although we've done some runs at it which have failed. And on the 8-hour, you can see that the rolling over that we were having with the MACD is now rolling over and turning up. So it looks like the bottom's still going to hold at this point. I'm still expecting a rally, and this volume spike may be a precursor to that rally. So I wanted to jump over a topic that's come up quite a bit from a number of commentators who have pointed out that I often refer to the manipulation of the silver market and the involvement of the COMEX and the CME, and obviously other groups like JP Morgan and possibly even the Federal Reserve. That is speculation, but I wanted to address this issue of why I use these charts and why I think these technicals are valuable. So I'm going to go back to the beginning, and we're going to read a little bit from Jesse Livermore again. This is the link that's on the U.S. archives. The book is in the archives, but the last link that I had is dead, so I'll repost this link so you can read it. And this is from the beginning of the book, where Livermore is talking about the essentials of technical trading, which is technical analysis, sometimes referred to as tape reading, and he goes into the essence of that, and I'm going to read that to you and then I'll comment. He says, I got so interested in my game and so anxious to anticipate advances and declines in all the active stocks that I got a little book. I put down my observations in it. It was not a record of imaginary transactions, such as so many people keep merely to make or lose millions of dollars without getting the swelled head or going to the poorhouse. It was rather a sort of record of my hits and misses, and next to the determination of probable movements, I was most interested in verifying whether I had observed accurately, in other words, whether I was right. Say that after studying every fluctuation of the day in an active stock, I would conclude that it was behaving as it always did before it broke 8 or 10 points. Well, I would jot down the stock and the price on Monday, and remembering past performances, I would write down what it ought to do on Tuesday or Wednesday. Later, I would check up with actual transcriptions from the tape. This is how I first came to take an interest in the message of the tape. The fluctuations were from the first associated in my mind with upward or downward movements. Of course, there was always a reason for the fluctuations. Now, this is the essence of technical analysis. There's always a reason for the fluctuations, but the tape does not concern itself with the why and the wherefore. It doesn't go into explanations. I didn't ask the tape why when I was 14, and I don't ask it today at 40. The reason for what a certain stock does today may not be known for 2 or 3 days or weeks or months. But what the dickens does that matter? Your business with the tape is now, not tomorrow. The reason can wait, but you must act instantly or be left. Time and time again, I see this happen. You'll remember that Hollow Tube went down 3 points the other day while the rest of the market rallied sharply. That was the fact. On the following Monday, you saw that the directors passed the dividend. That was the reason. They knew what they were going to do, and even if they didn't sell the stock themselves, they at least didn't buy it. There was no inside buying, no reason it should not break. So that's a very important understanding that you need to have about technical analysis. Now in this case that Livermore's talking about, which is a stock, and you could consider this inside trading. This was a stock where the directors knew what they were going to do. They were going to pass the dividend, and the stock collapsed in price before that news was announced. So the point being that the technical analysis tells you what is going to happen before it's announced. That's because the actors who have the inside information are acting, and that's reflected in the tape, specifically the volume and the price. Now, back to silver. People have asked me, do you believe this is manipulated? Yes, I believe it's manipulated. But do I believe that these prices and volumes are accurate? Yes, I believe these prices and volumes are accurate. That's the important distinction, is that even though I believe that there are a lot of short sellers who overhang this market, and this is the paper market. Now remember, this market is connected with the physical market. This market is not disconnected from the physical market. If you remember when I did my video about buying at 26, actually I bought at 28, but that evening I was watching the tape very carefully, and I was timing my buys at the website based upon this price movement. That's because the prices on APMEX were actually moving with this price. So this market price is tied to the physical. As it changes here, it changes on APMEX. These are also real price movements of a real market on the COMEX, and overnight trading, including the LME and the TOCOM in Tokyo. So these are real prices. Now they are actually for derivatives, because those derivatives are futures contracts which are derived from the physical delivery that's going to be delivered in the future. But nevertheless, these are real prices, these are real events, and these are real volumes. So they have meaning and they're important to analyze. Now, I wanted to compare that to something to show you how I feel that's different from something that's purely manipulated and something that I don't trust at all. So this article here, if you remember the May flash crash that happened on May 6th, I don't know if you recall when that happened, but that actually occurred. The flash crash was actually occurred at the same time that I believe it was CNBC and the other news networks were showing images of Greece with burning dumpsters and riots and crazy stuff going on. Same sort of thing that's going on now, and that was accompanied by this flash crash. Now the Dow dropped, I believe it dropped 800 or 1,000 points and rallied most of that back, but this article actually gives you some charts of stocks that traded at that time. Now these 6 stocks, we have Accenture, Exelon Corp, CenterPoint Energy, TransMontaigne Partners, Impax Laboratories, and these stocks, you can see, they actually traded at zero. Accenture, the consultancy opened at 41.94, hit zero at around 2:50 p.m. and then closed at 41.09. Exelon opened at 43.35, hit zero, and then closed at 41.86. CenterPoint Energy opened at 14.39, hit zero, and then closed at 13.88, and so it goes. Now, These markets, as opposed to the silver market, I do not consider these the same thing. These are actually fake markets. The fact that these prices could hit zero and rally back 100% essentially is proof in my mind that these are fake markets. They're not real anymore. They are controlled by computers, and there are not real buyers and sellers involved, and they're able to be driven to zero and run all the way back. This is a market that not only would I not invest in, but I would not even follow the technicals in, because the technicals are fake. Now, I do not believe that is the case with silver. One of the reasons I believe that is because the volume corresponds accurately with the price movement, that the deliveries and the outstanding contracts line up with the price movements, and the delivery is real. Although it's a very small percentage, it actually occurs. And of course, the main key is that these prices are actually lined up with physical coins that are being sold on APMEX and other sites. So I consider this a real price, while the other I consider a fake price, and that's one step beyond. If I believed that the silver market was like this, that it was purely a computer-driven market, and there is no real trading that's actually going on, but it's fake trading, I would not be doing this charting, because at that point I would start to chart. If there were an index of it, I would start to chart an index of the physical price. And I think that we're going to see that probably when the physical begins to disconnect from the COMEX price. We'll probably have charts of the physical, and I don't know how that would work, but there'll probably be alternative exchanges and things like the Bullion Direct and things like that. We'll get some data on the physical and how it's trading. So I don't believe we're at that point, but at some point in the future we could get to that point. Until then, I'm going to go ahead and continue to analyze the technicals, because I think it's useful information. So I hope that answers that objection. Now, back to this topic of the flash crash and other panics that we've seen recently. There have been a lot of people talking about, especially with Occupy Wall Street and things going on in the banks, and I wanted to briefly touch upon the recent Bank of America story that has come up, where Bank of America has essentially backstopped one of its gigantic derivative books by shifting it over into the FDIC insured area of its business. So that's covered by Zero Hedge. There's been a lot of commentary about that, roughly $53 trillion. I saw a video today where the commentator stated that the people who were the ones in line for the derivatives contracts would actually take first in line in front of the savers. So, and I don't recommend anyone relying on the FDIC. We've already had instances in 2008 where the FDIC did come in and bail out the banks and paid off the depositors, which I believe is up to $250,000 today. Under the financial crisis, it was moved from $100,000 per account up to $250,000. But there have already been instances of people who've had to wait weeks or even months for their money. Now, this actually complicates it even more if, in fact, and I don't know if that's the case, but if in fact the FDIC insured savers have to get in line behind these $53 trillion in notional derivatives. So that's another scary one, and the topic is financial collapse. So I wanted to go back. A lot of people have asked me, along with the silver chart and the technicals, a lot of the questions are, how long can this go on? In other words, how long can the banks, the Fed, the government kick the can down the road? And I want to be clear that I believe, although I have a conspiracy site, and obviously I believe in conspiracy theories, in this case I don't think that the explanation needs to be conspiracy. I think the explanation is pretty clear, that the reason why the can is being kicked down the road is because the consequences of what would have to happen if they came clean on the situation would be catastrophic. So I wanted to look back on a couple of videos that are fairly famous videos most of you have seen, but they were ones that occurred that give you a history of what happened at that time. This first one is Representative Brad Sherman, and this is a fairly famous one. I'll just let this play.
From Ohio. The only way they can pass this bill is by creating and sustaining a panic atmosphere. That atmosphere is not justified. Many of us were told in private conversations that if we voted against this bill on Monday, that the sky would fall, the market would drop 2,000 or 3,000 points the first day, another couple thousand the second day, and a few members were even told that there would be martial law in America if we voted no. That's what I call fear-mongering.
Now, that was the famous speech by Brad Sherman, and I wanted to take you to another commentary. If you remember at that time when they were debating some of these bills, this is another interview by Congressman Paul Konjarsky, and he's talking about the run on the money markets that occurred at that time.
Treasury to act.
So what would you say, though, then, to somebody who says Paul Konjarsky is supporting Wall Street but not Main Street with this latest $825 billion package now moving through the House?
They are right to this extent. Why did we do that? We did that because the Secretary... Look, I was there when the Secretary and the Chairman of the Federal Reserve came those days and talked with members of Congress about what was going on. It was about September 15th. Here's the facts, and we don't even talk about these things. On Thursday at about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours, the world economy would have collapsed.
Okay, so that's the summary. Now, I don't know if you remember that, but that was when he's referring to when there was a run on the money markets and they actually applied the FDIC $250,000 per account backstop to money markets. That was unprecedented at the time. So now I have a little bit different take on this than Congressman Brad Sherman, and I'm a little bit closer to Paul Konjarsky on this. I'm not advocating what they did because obviously at this point in time, although I would like more time, as anyone would like more time, I was pretty much already prepared for that sort of thing to occur. So the vast bulk of my assets were not in that system, as I recommend today to you not having the vast bulk of your assets in that system. So there were many of us who were prepared for that to happen at that time. But what I want to point out is that if that would have happened at that time, then there would have been something much worse than what we're seeing today with Occupy Wall Street, the Greek riots. In other words, many people's retirement accounts and pension funds, if not all, would have gone to zero. Their money market funds would have gone to zero. Their stocks would have gone to zero. All of the paper assets and debts would have gone up in a gigantic bonfire. AIG would have gone bankrupt. Every bank in America would have gone bankrupt. Probably every insurance company in America would have gone bankrupt. Probably Fidelity and every mutual fund company would have gone bankrupt. In other words, every paper asset would have gone bankrupt and would have been vaporized at that point. So I do agree. I don't agree with the bailouts, of course, but I do agree that the crisis will be that great when it occurs. So, what is the point of this? The point is this, that people have asked me repeatedly, why are they kicking the can down the road? The reason they're kicking the can down the road is because they, being the politicians who are in charge of our government and the governments of Europe specifically and other countries, know that they will be held accountable if that type of scenario occurs, because it probably will coincide with martial law. It probably will coincide with the shutting down of the financial markets. It probably will coincide with bank closures, bank failures, and possibly even a worldwide bank holiday where all banks are closed. So I think that probably what they told Brad Sherman was accurate, that if they allowed that to happen, that would have happened. And probably what is happening in Wall Street today and what is happening in Greece today would be considered a walk in the park compared to what would happen if you told all the people who are retirees that their retirements are gone. They're vanished. They're vaporized. So I wanted to point that out. Again, I do see value in technical analysis of silver, and I do see not a value, but a reason why, a simple Occam's razor, explainable reason why, that the politicians are trying and successfully, up to this point, kicking the can down the road as far as they can, because they certainly don't want to be in office when they have to tell everybody that they've spent all the money, all the promises that they've made, and that you're seeing that in Greece. All the promises that the politicians have made cannot be kept. The governments are bankrupt, the banks are bankrupt, the whole system is bankrupt and has to be reset. And when it is reset, a lot of people are going to lose. So that is your reason for being in physical silver. It's not just an inflation hedge, it is a deflation and default hedge. And it seems to be, even though it has had very recent smackdown, 2 of them, it seems to be recovering fairly nicely. You should look at that as a gift, just like this $8.50 bottom was a gift. It's a time to stack and get prepared for what is coming, which is going to be at some point, if they don't just slowly hyperinflate things away, which of course will be very bullish for silver. If they don't do that, then there is going to come this collapse point where they just simply shut down everything. And if that occurs, you're going to want to have your food and essentials, you're going to want to have your silver and gold, and you want to have a certain amount of cash, because at that point it's going to take quite a bit of time to reset the system and you don't want to be caught flat-footed. And we'll talk to you next time.